Hey, everyone. Thanks for everyone who's showing up today. It's a big deal at Markman Capital. We're doing live video now. Can anyone in the chat just let me know if you can hear me all right? Just do a quick test. Just give me a thumbs up if you can hear me, or just type yes. That'd be fantastic. Awesome. Thank you, Bob. Appreciate you. Always do. All right, guys. Well, let me get this set up real quick, and we'll get right into it. All right. Hope you guys appreciate the cow over here. We're going to be going over our cash cows today, so I thought I'd plan the art appropriately. All right. Here we are. Let me make sure it's all straight. All right, we're good to go. All right. So today we're going to go over is a little bit of macro analysis on the markets, what we see for the next year, potentially 18 months. We're also going to do a little bit of housekeeping on our current stocks. We're also going to go over two case studies. Funny enough, we're going to go over two case studies. One stock that for all of our long-term viewers, we've loved for a long time, but are not in any portfolio. So there'll be some more news around a new newsletter that we'll be launching soon. And then we also have a big Q&A at the end here. A lot of you submitted questions already, and we really appreciate that. We did what we could to prep it all, to have it all in the presentation, but the ones submitted this morning, the slides are a little more ad hoc, and we'll get through them as much as possible. So anyways, we'll dig right into it. All right, so first and foremost, I want to let everyone know you guys are all the core of what we do here at Markman Capital. You're the reason we get out of bed in the morning, and you're the reason why we try so hard to at least understand what's going on in the markets. You're all 6, 7, 8-figure investors who actually want to understand the machine and not just chase tickers or hypes. There's so many services out there that are pitching you the next best thing, and we really appreciate all of you that understand the next best thing is never really the next best thing. And so appreciate you for sticking with us and holding strong on those core holdings. So my job is simple today. We're going to show you where the real transformation is and give you a system that you can write it. We'll talk a little bit about allocations as well. But first and foremost, I have to remind you, this is the lawyer. I am not a financial advisor, at least not yet. This time next year, there might be a different story though. So we're here to give you a system that will help you ride the digital transformation, help you stay invested through cycles without blowing yourself up. And with all the rhetoric in today's world, it's pretty easy to get a little ahead of ourselves. So here's the path that we're going to go through today. We'll do a macro and market regime analysis. We're going to go through buckets and allocation of capital, at least what Markman Capital at least is intended with our newsletters. Again, that is all up to you at the end of the day. We'll go through some core themes of what we see for the immediate 12 months, 12 to 18 months. We'll go through two case studies. We'll go through the Markman method, and then we'll do some kind of risk and discipline analysis at the end, and of course the Q&A. All right. So macro regime. Basically, the water we're paddling in right now is pretty calm on the surface, but it is choppy underneath. Rates are low and relatively stable around 3.25. Maybe one cut this year, maybe two. We'll see. And inflation is boring. Finally, I mean, that's actually super cool. It's super good to be in a low inflationary environment, and it's living in the 2 to 3% zone. And this was definitely helped by the tariff reversals over the last year. Obviously, tariffs would drive up inflation, but that seems to be just more of a bargaining chips as Trump is using them. So the reversal of those has really helped the inflation stay low. For most companies, earnings look solid. We're looking at around 8% growth for the S&P, and with margins near record highs, thanks to AI and a couple other structural things behind the scenes boosting productivity. I think the real AI productivity gains are yet to be seen. All right, so for 6, 7, 8-figure investors, three things really matter in the next 12 months. One, the AI super cycle. We do think we're in a super cycle. This is huge. And the reason it's not a bubble, which you've heard us talk about in all of our different publications all the time, is that all of this is free cash flow funded. And so it's funded by actual revenues from actual people buying actual products. There's no leverage or circular deals. There's no lending. There's no debt. It's just free cash flow. And that is what's building the that's what's funding the build out of compute and software that will touch and has touched every industry. A little aside, for those of you who have been with my father for over 25 years, you'll know that in the beginning, the digital transformation was more of a phrase, more of like a fringe thing. It was, all right, well, those are our tech stocks. They weren't the market. And if you've noticed over the last 25 years, the digital transformation is now in all industries, and they are. Mag 7 is, to a certain degree, the market for a lot of these things. And so you've seen the digital transformation just kind of creep and grow and engulf everything. And now we're going to see that in an AI super cycle. All right, 2, the policy mix. We're seeing tax cuts, deregulation, and gradual Fed cuts. This is definitely broadly supportive of risk assets and growth stocks. And we at Markman Capital love growth stocks. John Markman, our father, obviously has a saying where if you had to choose value over growth 100% of the time. Well, he might caveat and say 90, but in practice, how we operate and how the company operates is growth all of the time. Those are where the great companies are at. There's a reason they're growing. And then 3, earnings are starting to broaden beyond the Magnificent 7 into cyclicals. And what matters a lot less here are the day-to-day headlines. The market will give you 50 reasons a week to hit sell, but most of them don't change the 10-year cash flows. So a lot of the battles we're going to be fighting and what we're talking about today, and a lot of the battles we do fight in our daily lives when it comes to our portfolios, is more of narrative-based. It's not really structural or fundamental. It's narrative. It's he said, she said. It's manipulation through narratives. And so that's going to be a big thing to kind of look out for this year. All right. I always like to think in paths, not point predictions. We're not Nostradamus as much as we would like to be. We're not. And so let's look at the base path and then the risk case for this year, because there's always a chance of risk. So the base path, a soft-ish landing, growth around trend, and unemployment a bit higher, but not crisis level, and the Fed cutting gradually, not panicking. Earnings growth widens out as AI CapEx expands, reshoring comes back to the United States, and fiscal programs show up in the actual productivity. And inflation wiggles in the low 2s to 3s. That's the base case. That's what we're preparing for. Now, what's the risk path? What could we miss, and what's the risk path on that? There's always this possibility of a pocket of hidden leverage in the private credit or shadow banking world that snaps and causes a funding freeze. I mean, that's was 2008. It was bankers' policies behind the scenes that impacted the entire market. There's always that chance, and there is a lot of credit right now in the car loan space and the private credit. Those are at all-time highs. We don't necessarily see that as being a thing to implode. And you've seen Trump administration talk about really a populist agenda point of capping credit cards rates. So this is definitely in a lot of people's minds, but that's basically the risk path here. And that's when people start questioning the Fed's independence and its ability to manage a real credit event. And our job here is simple. It's to position for the base path while making sure we survive the risk path. All right. So where we think at Markman Capital, a lot of investors will be facing backwards on AI is at some point we're probably going to see a 20 to 30% drawdown in those leaders. We think there's a potential in the first quarter, but it's an easy narrative. But the easy narrative, and this is something we have to watch out for. The easy narrative among all the talking heads will be bubbles popped, it's over. I don't buy that. We don't buy that. A sharp correction is just a positioning and valuation reset, not the end of a secular trend. That's the big thing that we talk about here at Markman Capital, secular trends over the long term. So a 20, 30% blip is really nothing in that long term. And if anything, it's why we mentioned it in a few of our letters to always stack cash on the side for those events so you can buy more of our favorite stocks at a deal. AI is electricity. It's not a meme stock. And for you, the bigger risk isn't riding a drawdown. It's being structurally underexposed to a 10+ year productivity wave just because of a headline that scared you out. All right. So we're going to spend the next 4 slides just going through macro charts on the markets, just to kind of show our bull case for what's going on here. As you can see, the S&P 500, there's support around the 6,100 mark with critical support around 5,900. And we believe a breakout above 7,000 could propel the index to 7,500. And what we saw yesterday was the S&P 500 briefly hit 7,002 before dropping down quite substantially. At least when I last looked at it a couple hours ago. This morning, which is totally predictable. Bears will come at the top and try to protect their positions and take gains. And so, the fact that it touches it is very bullish that it will go up there and maybe even ride up the 7,500 soon. All right, the NASDAQ 100 index support is at the 22,000 mark with critical support at 21.5 thousand. And then after that, there's no important resistance until on 29,000. So again, another big case of, hey, this really could ride a while. Again, the Dow Jones support is at 45,000, then around 45,000, but major resistance is at 50,000, but then it's at 51,900. So again, we do see the same trend continuing here. And this is the treasuries. You can see a head and shoulders pattern right here, one of our favorite in our profit for patterns guides. And this is the 20+ year treasury bond that continues to build a bullish reversal pattern. Lower bond yields would be positive for stocks over the long term. So that's what we're seeing. And that's what we're anticipating for the rest of this year. If you do like these charts, these are actually from our Markman quarterly report. And we do a lot of in-depth macro and micro analysis there. Financials continue as market leaders, and we believe this strength reflects investors' anticipation of an early cycle economic recovery and a stronger IPO market. And I think it was in the news yesterday. Elon and SpaceX is targeting, I think, like June 6th, right around then, IPO for SpaceX at 1.5 trillion to raise 50 billion. And if SpaceX is coming and the largest IPO in the history of markets, chances are we'll see a lot more. So this could be IPO season, which is honestly pretty exciting. All right, so what are our key takeaways here? On the surface, investors look optimistic. Cash levels are low. Sentiment is high. And most professional money managers are leaning bullish. At the same time, there's a loud narrative saying tech is in a bubble and AI is overhyped. And somehow this all will end in economic doom. We don't buy that at all. Real market bubbles come from oversupply. What we have right now is the exact opposite. There is a global shortage of compute. There simply aren't enough GPUs, NVIDIA GPUs specifically, to meet demand. And that matters a lot because AI isn't the story. It's the infrastructure of the next productivity boom cycle. And over time, that productivity infrastructure will drive earnings, and earnings will drive markets. This is where some things get a little tricky. Some investors are selling their AI winners, but they're not leaving the market. They're rotating into early cycle non-tech businesses they expect will benefit from the next AI, will benefit from AI next. And that's the risk. Our concern isn't big tech. Those numbers remain solid all year. The risk is everywhere else. AI adoption outside of the tech core is slower than investors expected. And that gap between expectation and reality will cause volatility. And that's why we expect turbulence after the Q1 earnings. Not because AI is failing, but because the benefits aren't evenly distributed yet. This rotation is cyclical stocks that may be early. If productivity gains don't show up fast enough, then the market has to reset its expectations. A 10% correction in the first quarter would not be surprising. The takeaway is simple. We're going to stay disciplined, focus on quality, stick with businesses that already produce real earnings, and technology is the transformation. And that part is in no doubt whatsoever. And the timing, that's the variable. So the only thing to really watch here is the timing. And timing is what dictates the market direction. So yes, those are our takeaways for our macro regime. All right, so this is a little bit more of a how we like to think. We like to think in buckets. If we take a hypothetical 60-year-old with 3 to 5 million, again, this is not personal advice. We would potentially want a foundational bucket, a growth bucket, and a small leverage bucket. Foundational ETFs is our foundational bucket. I will say this is kind of an early bird announcement. We are completely redoing that letter and relaunching it in the middle end of next month. It's going to be called Compound and Conquer, and it will be similar letter, still the daily end of market analysis, but we're also going to comprise eventually a 70 to 100 booklet of, it'll launch like 38 stocks, but it'll eventually be about 70 to 100 of stocks that we think will win in their niches. So that's pretty exciting. So basically stocks that you can compound in, they conquer their industry. So we're really excited to relaunch that letter. And a couple of examples of those would be Costco, Amex, McDonald's, things that aren't necessarily tech focused. All right, and growth, your growth portfolio, that's your DCC style names. That's NVIDIA, that's your Broadcom, that's your Oracles, the companies that are actually building and monetizing this transformation. And then the last portion is we do believe in a little bit of risk, because what's life without a little bit of risk is digital leverage. And we think that should be the smallest portion, maybe 5% of your capital at most. And since we do think there will be a lot of volatility this year in the market, with the general trend growing higher, options are a good way to actually play with that volatility and make it a little bit more fun. All right, so allocation mistakes to avoid. The mistakes that we see over and over again are pretty predictable. Concentration in stocks without conviction. And usually that's big bets and hot themes people really don't understand. Take quantum, for example, earlier last year. A lot of big bets, people really don't understand it. How's it going to be used? Does it interface with current computing? It's still all a little bit dubious. So they were hot, they did ride, it was a theme. But was there a lot of conviction behind that? Probably not. Probably needs another 10 years to really figure all that out. Another mistake we see is over diversification, just buying 30 to 50 tiny positions that basically recreate the index with more fees and less clarity. We subscribe personally to a few other marketing, financial services, a lot for market research, but also to see what people are talking about. And the amount of stocks in a portfolio that some of these places have is just absolutely overwhelming. And we really think that's a detriment to building a true fortune. One of the sayings that I grew up hearing from John all the time was diversification is a detriment to a true fortune. And it's kind of counterintuitive, because you're always taught like diversification, but true fortune is not made through small buckets. It's through one big bucket, and then you can diversify. Diversify saves your assets. That's not really how you make it. So if you want to replicate something that's a little bit more wealth and growth focused, less diversification in high conviction areas, aka our growth stocks, our tech stocks, that's one way to kind of have a little bit of diversity while at the same time being focused within a core sector. Another big thing is ignoring asset location and taxes. So like example of this is trading like a maniac in a non-taxable account, and then wonder where your compounding went. And I'm actually guilty of this. The portfolio that I trade publicly in the digital leverage letter is not in a tax-free account. So that will be changing this year, but I am paying taxes on all of the gains there. And so on all of the gains there. So we'll be switching that. And I really think, for some of you that do this, it's something to look into as well. And one big thing here is having static allocation, never revisiting your core holdings as regimes shift or as things change. You really should take a time once a year to really visit your core holdings and see if the themes are still true. Thankfully, with us, we kind of do that for you, and the digital transformation is still a secular theme with a tailwind. So we got you covered there. All right, so here are a couple quick rules of thumb that we'd love you to steal. First, the idea is to buy assets you don't plan on selling. That forces you to be extremely selective, and that's the point. We quote this all the time, but Best and Bender study out of Arizona in 2018 found that over the last 100 years, that 52% of all of the gains in the stock market came from only 3% of stocks. That means 72 out of 55 or out of 6,500 accounted for over 52% of the gains. That means it's less about owning stocks and more about which one. It's less about owning a bunch of them and more about owning a select few. And so we want you to be extremely selective. Second, if something feels like a bet, it doesn't belong in the tiny bucket. Don't let fun trades creep into your core. And third, for trading in options, think in ones. 5% of total assets or less per trade. You can't control the market, but you can absolutely control how big you let it hit you. All right, so let's dig into some core themes. And I do have to apologize, guys. I do have two very young kids. I got a 2-year-old and a 11-month-old as of yesterday, and they got me quite sick last night. And my wife and I were up at midnight, 4 a.m. Well, really, my wife, she's a trooper, but I definitely got a little bit of it. So apologies to all y'all here, but thank you for still showing up. I personally really do appreciate it. All right. So for 2026 and beyond, the 3 big rivers we're trying to ride are the AI infrastructure, the rebuild of the power grid, and broad digital transformation. And our case studies will kind of go into the broad digital transformation. It'll be apparent why we're choosing these companies just as a theme. So this includes subscription models like Costco. So all 3 involve long CapEx cycles, real productivity gains, and a pretty simple through line. And if you shut them off, the modern economy stops working. And this is what we mean by secular. Funny enough, growing up with John, I heard all of this, but it wasn't until I actually worked with him the last 5 years that I really got to understand what these terms really mean. Because secular to me was always just kind of like religious or secular, not necessarily a theme that could be applied to your daily life over a trend. And so what we mean by secular is that these themes are persistent, they're omnipresent, they will exist for the long term. We really want to pay attention to those. And this part is cool, and I do want to hear some feedback from you in the chat if you're cool with this. A lot of this is happening in Texas. I'm in Austin, Texas, and we want to aggressively go out and start filming stuff in Austin, Texas. Give you footage, videos of inside the tours. We have the new Tesla lithium factory down in Corpus Christi. I actually went up to Project Stargate. I couldn't get a tour that day, but I want to get it. I want to go back and do that. But please drop a comment here if you would like this, if you'd like to see more of those, more man in the street, trying to get a hold of people at these companies and really trying to interview them, because a lot of this is in Texas, and a lot of it's really close to me, which is pretty cool. So just either drop a comment or let me know if you want to see some of that, because we would love to provide that content for you if you find it valuable. All right, so AI infrastructure. The headline is massive CapEx, maybe a bubble, but the underlying story is much more interesting. AI workloads could easily triple global data center capacity by 2030, and most of it is AI specific. Hyperscalers are funding. Can you guys still hear me? I just got a call through here. Didn't want to make sure it messed up my microphone. I think we're good. Okay. AI workloads could easily triple global data center capacity by 2030. Most of it is AI specific. Hyperscalers are funding a lot of this from their free cash flow. Governments are chipping in where national priorities are at stake. The payoff is digital workers, models that handle work like a person could have done, which shows up as a higher margin and faster decision cycles. The risk is not that this goes to zero. The risk is that monetization is lumpy and investors get impatient. That's fine for us. I will say, if people are interested in this as well, I've gotten really deep in personal productivity AI tools. And that's not just using ChatGPT. I'm in the middle of building out a personal bot that will live on my computer. Well, I'm going to put it in a virtual server, but it will live and essentially interact with everything that I do, store files, and basically feed me information when I need it, do research, all these kind of cool things. I think once you start digging into what these AI tools can actually do, the world completely opens up. And I've had this, my wife's been, she would never say this, but she's been telling me to go, I've been working extra at night, just trying to build these AI models, just because I haven't been this excited about technology in a long time. And quite frankly, it's so cool. And I think once you actually dig in and just try to do something with it, and you see the little speck of what it can do, it's hard not to have unbridled optimism for the future of this tech. Yeah, some workers will get replaced. Those workers will probably be replaced anyways. The ones who actually engage and learn these new tool sets will be unbridled. And the amount of quality work you can get done in an amount of time now is kind of ridiculous. Thanks, Bob and Atlas, for those comments. Yeah, I can. Once I get the bot fully built out, I'd love to share it with you. It's going to be super. I'm just so excited about it. All right, well, I'll stay focused. Sorry. So rebuilding the power grid. So the grid as it exists today is basically a patchwork 20th century boat, and we're trying to paddle in 21st century rapids. So you've got aging wires, you got intermittent renewables, slow permitting, and in Texas it's very fragmented. A bunch of different private companies all all together competing for your electricity bill. The result is a multi-$100 billion investment cycle to rebuild transmission firm from the power up, and it keeps moving. The natural winners are regulated utilities with allowed returns, data center focused power providers with long dated contracts, and the handful of players who actually know how to build and modernize the grid. It's pretty incredible. Just the replacement of pure mileage of wiring that's going on is a huge opportunity, and we still think it's particularly underpriced. I mean, last year utilities got upgraded to growth stocks. When was utilities ever a growth stock? It's kind of crazy. So digital transformation and subscriptions. So the digital transformation is the quiet compounding force in the background that's driving the secular tailwind, and it's turning physical workflows into bits, which lets companies see everything in real time and re-architect how they make money. The classic example is Netflix going from mailing DVDs to streaming. That was a very early version of this. Now it's happening across manufacturing, logistics, finance, and healthcare. Generative AI is accelerating the trend by automating workflows and analytics, and the hyperscalers let companies rent scale instead of building it. It's pretty cool. So the key takeaway for us is measurability. Are there 20 to 30% efficiency gains, clear ROI targets, and governance? If yes, it's not hype. It's a new baseline. So inside every hot theme, there are a few real long-term winners and a lot of stories. We separate them with 3 questions. 1, do the economics work? Are there high gross margins and positive free cash flow with even big CapEx? 2, is there a moat? Is there proprietary data? Is there network effects? Or is it just an AI label on a commodity business? We see those a lot too. And then 3, do we see real demand? And this comes through in recurring contracts, big backlogs, and rising utilization rates within products. And if those boxes are empty, it might be tradable, but it's not a core secular winner that you should have in your investment portfolio. Again, it's investments versus trades. They're 2 different things, and we have to make sure you know which is which. And so Costco is kind of, let's call it the anti-hype story. It's a membership fortress. Over 130 million cardholders. I'm one of them, and I have converted my New Jersey in-laws to Costco as well. So they are Costco people. And their renewal rates are over 90%. And those membership fees are more than 70% of the operating income. That lets them sell goods at margins competitors just can't match. You've got steady comps, fast-growing digital, and international still ramping, and they sit on huge cash piles. Earn mid-teen return on capital and compound early, roughly 10 to 12% a year. And for me, that's a compounding conqueror for sure. That's definitely bucket material, something you'd be happy to own for decades if these holds. Internally, one of our head researcher, main researcher, he loves Costco. He talks about the problem with Costco is there's just not enough stores. That's a good problem to have. It means there's demand, and the only thing that's not easing that demand is accessibility to the stores. And I don't know if this was, I think maybe 2 years ago at this point, but when they started opening in China, Costco, and you see these queues just going, like I think it was like a mile, 2 miles outside the store, people waiting to get in just to see what a Costco looked like. It's kind of incredible. There's very, 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 very few companies that can do that for decades. So another one is we have a recent buy order on Hut 8. We really like Hut 8 and really want to pick this one up. So Hut 8 lives closer to the growth and leverage side of the spectrum. They're taking infrastructure that was built for Bitcoin mining and repurposing for AI collation and hosting. By the way, AI collation, which is a great term, is the practice of renting space in a third-party specialized data center to house an organization's own high-performance AI infrastructure. That's renting in the data center world. So these sites are huge. They're 300 megawatt sites next to real nuclear power plants, and they're leased to AI tenants with real needs. The Fluid Stack deal towards the end of last year, Fluid Stack deal, which was backed by Google, was a huge example of this. Hut 8 also holds a meaningful amount of Bitcoin in their treasury, and they have a big pipeline of new capacity funded by serious partners. It's higher volatility, but the logic is clear. You're owning part of the physical backbone of AI, not just another token. Excuse me. Across all this, we're really hunting just that 3% of stocks that drive the bulk of long-term wealth creation. They tend to have the same fingerprints: explosive earnings growth, high returns on capital, and a long runway to invest. Costco is the steady compounder version of that. Hut 8 is a more high beta version of that, which is tied to AI and digital assets. Hence the two different services, but also why we think they're important to be in different parts of your portfolio at the right price, so we can get into them. You don't need to own everything, but you do need to size up a handful of these engines correctly and give them time to compound. And the magic of compounding has really been drilled into me by John and our main researcher behind the scenes. But it's kind of this nebulous thing people say, just wait and compound. But the real example of this, and this is one of our best testimonials we've ever gotten. So results will wildly vary. But we first recommended NVIDIA first in 2012 and then again in 2014. And in 2014, one of our subscribers bought $10,000 worth of NVIDIA. That was at 50 cents. So meaning whenever the stock goes up 50 cents, he just got 100% gains. So today, when it's going from 180 to 200, that $20 is 20,000% gains because he bought it at that time. Granted, we didn't know what NVIDIA was going to be. There's a lot of luck involved. But that $10,000 is now worth $4.32 million. And he actually called into, kind of funny story, he kind of called into well, anyways, he said he sold a large chunk of it, so it would be worth more. But anyways, that's what we really mean by compound here. All right, so under the hood, the Markman method is just disciplined systems thinking. We start with earnings power, quality, moat, and duration, and we screen for companies where those four line up with a secular tailwind. Those are the candidates for our DCC. From that list, a smaller group that has the right liquidity and options structure, that's what qualifies for our digital leverage trades. Compound and Conquer, our foundational letter, plus our Friday letter, give you a full map of where we're seeing the markets in full of macro buckets and our core holdings. DCC, that's your growth engine. That's riding AI, the grid, and the digital transformation. The digital leverage is the little tiny rocket boosters on the back. Again, treat that one with capital. That's expendable. And then the bomb is just our bundle of everything for a hell of a deal. But it's where our most engaged members come, and we get a lot of questions from all of our bomb subscribers. We go really deep with all of those. The bomb also comes with a 45-page-ish quarterly report that we truly love. All right, so we're almost to the Q&A. So now we have to get to the hard part, which is behavior. Markets are an endurance race. The number one way to lose is by quitting at the lowest point. And in 2026, the behavioral landmines are selling secular winners too early and hanging on to losers out of ego. Oversizing leverage and letting narratives hijack your process. My rules are simple. I add to winners when the thesis gets stronger and when the position is still within my bands. And Markman Capital really likes the 20-day, 50-day, and 200-day moving averages as our bands. And I cut losers when the original reason to own them is gone, and not when I'm just feeling uncomfortable. And most of the time, I do nothing. I wait for the price to drop. I wait for Trump to threaten tariffs, and then the next day I buy more of my core positions and move on. Just keep on paddling. And yeah. That's really it. That's what I got for you today. But I do have a few questions we lined up, but I'm going to skip ahead to our submitted questions. All right. So thank you for these questions. So the question: What is the 2026 outlook for our bottom 5 holdings? And this was our most requested question, or some variation of this is. We're holding the DCC. That's Abercrombie & Fitch. That's ARM. That's Now. That's Oracle. And the Trade Desk. Should we continue to hold them? First and foremost, that's a great question. Let me say that a lot of this is long-term, and this is a lot of what long-term investors get wrong. People like to treat investments like stocks, little tickers on a screen, but they're not. These are ownership stakes in real businesses. and trading them like you're going to nail the top and the bottom, that's hard. That's very, very, very hard. And that's not what we do. We invest in real companies with real earnings and making real profits that are riding these secular tailwinds. Trading is hard. It's not supposed to be easy, and most people end up selling when the headlines are scary and buying when they're euphoric, which is exactly the wrong way to do this. So let me just dig into the five positions now. So for our bottom five, there are no fundamental breakdowns of these. The only thing that has changed is the narrative, and the herd thinks AI is a bubble, and some people even think OpenAI will fail. This is a little bit of an aside, but I do think it's important. We think that's nonsense. We think OpenAI is where Google was in '94, where Facebook was maybe in 2002. It's moving faster than any company in history, and the market it's targeting is enormous. And the consensus is early and likely wrong. So I also wanted to show you guys a little bit. This is for the trade desk specifically, because the trade desk has really taken a beating, especially within our portfolio. We love the company, absolutely do. Market hates the company. Not really sure why. I actually put this out on X yesterday, and I actually found, I got a few comments talking about people why they hate this company. But I want to show you this chart. This is the free cash flow of the trade desk. See how it keeps going up to the right? This is a beautiful graph. We do think the market will catch up with the trade desk as the free cash flow continues to grow. So we do not recommend selling it, especially at the loss it is now. It has secured its niche. It's doing well. So we do still like the trade desk, even though it does have that red gleam on the portfolio. All right, so Abercrombie & Fitch. As you can see, it actually still has a fair amount of free cash flow as well, and especially the orange line is earnings per share, so free cash flow per share. It's up at $10. I mean, this is kind of incredible, especially for a clothing company. There is a little bit of a downtrend there, but there was a little bit of a misadoption, I think, of one of their AI schemas last year. This being said, we still are very bullish on Abercrombie & Fitch as well, and we do not think you should sell it yet. We are watching it though, and so if there's something does change, just know we are watching it. And if you ever have any questions, please email us, respond to any of our letters, use the Ask on Anything portal, text the company line, send me a smoke signal. We'll always get back to you. All right, so second question. Are there any concerns with our top 5 DCC holdings? That's NVIDIA, Broadcom, Microsoft, Power, and Tesla. Let me grab something Monolith Power. Let me grab something real quick here. Yeah, so that's Quanta Services. All right. And we're back. All right. So nothing has changed. Let me say that again. Nothing has changed for our top 5 holdings. These companies are stronger today than they were even just one year ago, 2 years ago, not even 5. I mean, these companies are behemoths and absolutely crushing. The long-term trends driving them are intact. They're not just riding waves. They're building the infrastructure of the future. There is volatility, yes, but that is kind of the price of admission of these super secular trends. I mean, if it was easy, everyone would do well at it, right? And I think one of the things that we really try to harp here at Markman Capital is most of the volatility is, especially at least in how we invest, we find the tailwinds, we find the secular trends, we go for the long term. And our main battle every day is fighting the talking heads on the news, fighting what's trending on Twitter, fighting narratives that are being used to drive the stock down. So as long as the trends are still there, as long as there's free cash flow, we're compounding and we're making money. The fundamentals are not damaged at all. So no, we think they're doing great. And anyways, we appreciate you spending the question. All right, another one we got today. Is it too late to get in on memory shortages? They should last into 2027. Short answer is no. Memory within this industry is more of a commodity, and also unlike the other AI-specific semiconductors, many of the companies fabricate their own chips, and they can always add capacity as opposed to having their chips made by Taiwan Semiconductors. The fablessness is creating the bottleneck in AI, and we try to invest in those bottlenecks, so we have some sort of operating leverage, or because those companies have operating leverage. So again, the answer is no. It's not too late. Not too late to get in. How will war in Europe affect ARM and Oracle? Both have big losses already. All right, so this is more of a comment on the Ukrainian war and the fact that ARM and Oracle are down. ARM is our highest concentration position. We are very bullish on ARM. They are the toll booth of the semiconductor world with all their IAP. This is all centered around that they think OpenAI, that this is basically the market consensus around, or the market narrative consensus of this, that they don't believe OpenAI will become a major AI player. And ARM and Oracle are both major OpenAI partners. There is a disconnect between ARM and Oracle businesses, and between that and the perception. And for me personally, on Oracle, I went to school in Colorado at the in Boulder, and a bunch of my class, there's a bunch of Oracle campuses around Denver. And I had a couple friends that went to work for Oracle, and their jobs always sounded ridiculously boring. Ridiculously boring, uninteresting, and straight dinosaur. Now, with them actually building out data centers and securing contracts, especially with countries, Oracle is now one of our core holdings. I mean, it's truly transformed. They've allowed the small players, so Fortune 500 companies that aren't the Mag 7, to get in on generative AI and to add them to their system. So Oracle is doing fantastic, and we also think ARM. You can't really build these data centers without ARM. So it's more of a market narrative and perception versus reality of those companies. All right. Let's see. Do I have any other submitted questions? All right. That's what we got here. So let me see what we got going on here. All right. Hey, well, thanks, Atlas. I would definitely love to show you how I'm applying AI once I get that bot done. And Paul, hey, Paul. When will Markman invest again in VU? Right now, the foundational bucket has a lot of cash. All right, great question. We are looking to get back into VU on the next decline towards the November low at 600. However, that could change if there is now pullback through the end of the quarter. So we have our main researcher on our team behind the scenes answering questions for us here. So Paul, hope it answers your question. I missed a question here from Ted. All right, Ted. Your question was, seems to play both ways, Meta up, Microsoft down. Our answer to that is Microsoft is down on the idea that its enterprise software business is being disrupted. This is generally overstated. The companies building AI native software to disrupt Microsoft and other enterprise software companies face tremendous odds. They are mostly only building features like Excel integrations that can be easily replicated by Microsoft. The bottom line is you can't disrupt companies when you choose to build on their foundation. Yeah, it's Microsoft is really entrenched into everything. So, so for those of you who know John, he mainly is in the financial news business. I mean, it's because of his when his father passed away. That's kind of a whole hero's journey story there. But we ended up moving up to Seattle because Microsoft poached him to start the MSN Money column. And he only worked at Microsoft for a little bit, but he took me there quite often as a young kid, and it left quite a big of an impression on me. But he'd always tell me that you'd have an entire department and people whose entire 8-hour workday was devoted to just making like one button on Excel look better or perform better. And that's generally what these other companies are doing when they're trying to compete against an Excel. Excel can just either Microsoft can buy you, integrate you into their Excel, or two, just create the feature, create what your entire company does as a feature and integrate it. So it's very, very hard. Excuse me. All right. What are the questions we got here? All right. So we got our first question, which I appreciate. Ted, the Chicken Little AI budget. The expanded version of that question was, are we worried about to the extent that too much capital is being extended to build outs, assuming it's for AI infrastructure, or not enough? Great question. I think there's a big misconception people have been about open AI and how they operate. People are confusing its $17 billion in sales with infrastructure build-up plans for the 1.4 trillion. That's the Project Stargate. Because obviously 17 billion is nowhere near 1.4 trillion, but that's not what's happening. That 17 billion isn't what's going in to make the 1.4 trillion in infrastructure projects. OpenAI is not on the hook for that funding, not at all. OpenAI is committed to be the consumers of the tokens that the build out will create. It's basically like agreeing to be a tenant of that factory. Like you're agreeing to buy the supply, basically those floating point number tokens from the end of that factory. I hope that makes sense. Essentially, OpenAI is a leaseholder on, basically they're obligated to buy the tokens coming out of the factory, not actually build the factory themselves. And a quick little aside, I do have it was like a 30-minute masterclass on AI, the first layer of AI, on our YouTube channel here. And just real quick, I know this is basic for a lot of you, but it takes this whole new revolution is electricity is turned into floating point numbers through a GPU. Those floating point numbers are then the tokens that are redeemable from softwares to basically become in intelligence. So OpenAI, their main bread and butter is using the tokens to compute intelligence in different ways. It's like a really cool. So I mean, I've just been blown away by all of this. It's really, really cool. All right. All right, we got they cannot. All right, Mike, your question was they cannot create their own capacity. Bad data. Our response is Micron, MU, and Samsung do have manufacturing facilities, and they're not actually enough to satisfy current demands. So we do see this still being a growth sector. All right, Paul, we got Markman recently provided a discussion about Tesla's present full self-driving results that were not very exciting for Tesla. Long term, will Tesla's reach its stated goal on automated taxi service? Paul, I mean, I personally think the answer is yes. I'm also very much in the Musk universe. I'm in Austin. Some of my very close friends have made entire careers, especially on YouTube, just talking about Tesla for the last 10 years. So I'm very much thinking that I have a huge insight into how the real core true believers of Tesla operate and what their institutional knowledge is. And I also literally see the cyber cabs and the robo taxis driving around Austin all the time. I'm like this far outside of the zone with where I live, but where I go to work during the day, I can ride one. So what I've been planning to do, I was supposed to do it last week, but didn't do it because we had this huge freeze in Austin. But I do want to actually drive in one and just film it, and I'll upload it to YouTube so we can share it on our in the letter. But they operate flawlessly, and I've driven it behind a few of them in downtown Austin, and they're like, there are drivers that'll swerve to and from a little bit, and these cars are train tracks, rutted, exact. It's kind of, they're ridiculously stable. I do think they'll reach their stated goal. Maybe like caveat it by like 25%, because Elon does tend to overshoot his expectations. But I don't see how they wouldn't meet it. There's been this within the Tesla community in Austin. There's been talk that I guess some people within Tesla have been trying to potentially offer the Cybercab on a $500 a month payment, like no down payment. You get insurance, you get FSD, you get the Cybercab for just $500 a month. That's the two-door car. And I was talking to my wife about it, and we have 2 kids now. We actually have a third on the way. So there we go, made that announcement. But we got a third on the way, and she was like, "Oh, well, if it's $500 a month, like we would it'd be inconvenient not to have a self-driving car that to drive us around." So I do think there'll be a surprising amount of demand, especially at those lower price points. All right. Oh, sorry, Victoria, I missed your question. What about CDNS versus ARM? We like both. However, the stocks will need to stabilize before they can move higher again. But we will talk about when the timing is right. And yes, we know that is timing, which has been a big theme today. Daniel, should VGT and SMH be long-term core holdings? And the short answer is no. It's because semiconductors are a cyclical sector. There will be overbuilding of these, and we've been focused mainly on bottlenecks. Again, we really don't want to have a 30 to 50 position portfolio for you guys. I know we get this all the time when we're going to add more positions, and we would love to just take shots at things. It does make a letter more exciting, but our duty to you as tried and true financial researchers is to remain to our themes and stay disciplined. And so we really try to focus on the few stocks that own those bottlenecks. And yes, there's a bunch of names that are exciting. Maybe other friends are investing in them. Maybe there's great news on them, but we just haven't seen a high enough conviction in our research to add those to our portfolio. So yeah, well, guys, I think unless there's any other questions here, I actually really enjoyed doing this today. Got up to almost 40 people. That's actually a large amount of it's a pretty substantial amount of our subscribers to this service. So I really appreciate you guys coming here today. This will be recorded and live on the channel. All right, we got a good question. Bill, is this for me personally, or is this for just Markman Capital's official recommendation? What are the 8? His question, everyone, is what are the 8 stocks with your largest concentration? I'll give you a second to answer that. I'm actually invested in all of the DCC holdings personally. But my 3. One thing I've been doing is because of that saying. Sorry, 1 second here. All right. So, what are the 8 stocks with your largest concentration? So, Bill, I own almost all of the DCC holdings, but I definitely own our core holdings. Those are our 8 to 9 stocks in our thesis document. They are the ones that we put out monthly updates on in the updated thesis letter, which we will get another one at the end of next week. But those are our highest concentrations, and we really want to add those whenever you can. And again, this is not financial advice. Most of you have been in investing longer than I have. But one thing I've been doing recently, after talking to my father a lot, is my wife and I are on our investing journey. I've done a bunch of stuff to try to make money. I started a company. I had a freshwater restoration company that I started in high school. Gave it away at one point, sold my client list, and then I ended up just so much business with old web. Anyways, I took that, built it, sold it, thought I would make millions doing that. Didn't. So if anyone's curious, don't get into the freshwater restoration world. It's not where it's at. Even though it does feel good to help out lakes and streams and ponds and freshwater in environments. I was in the real estate industry for a long time, got actually completely overturned on a fix and flip. So I've been just trying to focus on exactly the financial world. And so one thing we've been working on is owning a little bit of everything in the DCC portfolio and then rotating between which 3 stocks I load up on monthly. So what my wife and I have been doing is basically choosing 3 of the core holdings. And whenever there's a dip for that month, setting aside cash. So like half gets invested of the cash we set aside, half we're investing in the overall portfolio. And then the other half is going into 3 concentrations of stocks. And we rotate the 3, but it's always within the core holdings. We really do believe in those stocks. It's not advice. We're not financial advisors. I have many years left in my investment journey. But because of that saying, diversification is detriment to a true fortune. I've been trying to figure out how do you have conviction in a few names while also diversifying. So that's kind of what we've been doing here. So yeah, I mean, does anyone have any other questions? I'm happy to stay on a little bit longer. I got more time, but if there's no more questions, I might wrap the stream. But yeah, and if you like this today, just shoot me an email just saying, hey, Joe, like this, you should do it more often. We're planning to do something like this once a quarter. And if people really like it, maybe we can do a less formal version of just a Q&A, more often. This was actually very easy. This is very easy as long as you guys like it on YouTube. This was very easy on our side. So this is great operationally too. So this is fantastic. And I will say too. So we're just to recap. If you haven't signed up for our free Friday letter, I would recommend signing up for it. It's called the 3% letter, and we're going to be, well, it was called that Foresight Friday. We're renaming it to the 3% letter, and we're going to be breaking down one thing we learned that week, a maxim, basically a trading maxim, because John has a bunch of quotes from the 25 plus years of him trading. We're going to break that down, and the goal of the letter is to teach the mindset behind the 3% of stocks that actually matter. So it's a great letter. I'm doing the bulk of the work behind that too, so you can get to know me a little bit more. The foundational ETFs letter, there will be a big relaunch of the letter, middle to later half of next year. Not next year, sorry, next month, and it's going to be renamed the Compound and Conqueror, because foundational ETFs turns out terrible name. We will still have the ETF portfolio, but we also have a booklet of basically not necessarily tech stocks that we think you could compound and conquer and pass on to the next generation. That'll be pretty cool. And then another big thing we're launching this year, just so you guys know, because you guys stand in the stream, is we've already sent this out to the bomb squads. They got to see it early, but we actually took, and this was quite a lift, but this is again why I'm so excited by it. So excited about AI. We actually took we have a little over 5,000 letters in our archive, and we took those letters and made a complete searchable database out of them. They're tagged, they're sorted, they're themed, and you can actually search all of the 5,000 letters. I actually can give you guys a quick preview of it. Since you're staying on the call. But we're basically rolling out a bunch of new this year, and we're very excited by it. So a little bit about this. This is just basically the vault. We have all 5,000 letters sorted by which newsletter it came from, and each one is tagged. So you can see in this section, this is every single stock. If you click any of these stocks, I'll just show you one right now. Arista, it has our current view on it, the evolution of the company over the last couple of years, and then questions about the stock. And these questions are exclusively answered from our letters. And then they're all sourced to these letters. It's still a work in progress. Like, this is not the cleanest way to display the data, but there's a lot of work. And so we're really excited to kind of bring that out. And oh, you guys can't see the screen? Oh, I'm sorry about that. All right. Can you see it? Let's see. Can you see it now? Oh, there you go. Thanks for letting me know. All right, so it's a complete database of all of our stocks. There's over 5,000 letters. Again, we'll just look at this, but you can essentially see every stock we ever talked about ever, and you can click any one of these, and it will pull up. Well, it'll pull up everywhere we've talked about it, but it'll pull up our current view and evolution of it, and what we think will be the most likely the questions you'll ask about the stock. And these are exclusively answered from the letters. So anyways, this is kind of one of those things where we're very excited to launch out. So thanks for sticking with me to this. I just kind of, this has been a side project of mine, because we know the archive is hard to search through, look through. We do plan on adding an LLM on top of this. So you will be able to ask it in intuitive questions, but that part turns out pretty hard. So anyways, well, I appreciate all of y'all. If you have any other questions, please let me know. And the only thing I have left for you today is, if you would like me to go visit anything that's in Texas, just let me know. I'm willing to drive, willing to make it happen. I want to get back up to Project Star